Even the US has limitations on it. But in order to be able to claim this as your principal residence, you can't claim any expenses for that home. So nothing's deductible. And if you have a loss on the sale of your principal residence, that is also not deductible. So you have a loss, then that's it. There's nothing to do about it. So now we're going to talk about a little bit about ancillary income in your principal residence. So you can rent out a portion of your principal residence while maintaining your, we call it PRE for short, PRE status on the entire property. But there are certain conditions that apply to this. So obviously, you must include any rental income in your taxes. And the rental portion is supposed to be small compared to the rest of your home. What does that mean? That's a very good question. The CRA will never give you a straight answer. All they say it's got to be small relative to it. And the reason why they don't give you like a number or something is because they don't want people to kind of come to that line and stay behind it. So they leave it open and ambiguous for explicitly for that reason. Ironically, if you want to have a principal residence exemption, it has to have minimal structural changes. So, for example, if you have a basement unit, this part is key, and you add a separate entrance, or you make a kitchen in your basement unit because you want to rent it out. Technically speaking, by the book, it is no longer considered part of your principal residence exemption because you made a structural change. And the CRA would argue that you did it for the purpose of renting it out, which is to make income. So then that portion will not be part of your principal residence exemption. So I talk about the technical side of it. When it comes to the actual application, it's always a question of fact. So, but that's something to consider that whenever you're doing any of these, like a major change to your house or condo or property, if you do a big change, if you do a change to it, automatically you're in that category that technically you may not be able to. The CRA could argue that's not principal residence anymore. So what does that mean for you all? Is that if you are buying a property that already has a separate basement entrance, already has a kitchen in it, and you bought that property and then later on you decide to rent it out, that is perfectly fine because you did not make any changes to it. It came that way. So that third point here applies if you actively make a change to that property. And that's why I say, so that's why I'm saying that. And we're getting to the ancillary income. The income tax act doesn't actually have a definition for what ancillary income is. So again, it's open to interpretation and it's a question of facts and circumstances. But generally, the smaller the portion of your house that's used for rental income, the easier it is to argue a position that it is used, that your entire house should be used, should be protected with the principal residence exemption. A good way to think about this is I have a couple of clients before we work with them. They're a couple that they both had home offices, and each one was claiming 20% on their each respective tax returns, and they were refiling it that way for years. So when they first came to us, we always do a review of the tax returns that they had done before to understand the situation. And the first question I asked them was that, do you know that your 40%, your claim to the government that 40% of your property is business use? And excuse me, and they were a little bit surprised because I said, think about it. You're telling the government 40% of my house is for business. I'm going to write off expenses, but I want 100% to be tax free. So, sorry. So that's the thing you have to consider is that the higher that rate goes, the more in risk you are. Finally,